Sold at 560.
First, 785, and second, be sure, 785, third, final time, sold. The third and final time at £910,000, sold. So, welcome to this latest edition of the Allsop Prop Chat. My name is George Walker, auctioneer at Allsops. I'm here today to discuss the auction market, what is going well in this tight market, and what will the next 6 months look like for auctions. With me today, I've got my esteemed, well, I think they are, colleagues, Richard Adamson and Will Clough. So, Richard, brief bio. Not everyone, amazingly, will know you.
Don't say that. Richard Adamson, I have been at Allsop almost 25 years. I'm a partner and auctioneer in the residential auction team, and I'm also the managing partner of the residential division.
Cool. And how big is the Resi team now?
We are 22 people in terms of the size of the actual team.
All in the office. Brilliant. So, Will, brief intro.
I feel like a spring chicken in this room. Only just coming up for my 15th anniversary at Allsop. Started as a graduate back in September 2010. Wow. So feels like a lifetime to me, but for you guys, it's just a small moment in time.
So shots fired early on, eh?
Right. Just do commercial, yeah?
Yeah, in the commercial auctions team. And I think we're about 17 people now.
Yeah, all in.
All in, so yeah.
Brilliant. And my name is George Walker. I've been doing auctions for far too long. 28 years, I think, and solely commercial. So hence we've got an overview today of looking at both markets, just to be clear. So Richard, just bring us up to date. I mean, Allsop's two separate teams, which is different in the market. What do the numbers look like for the last 6 months?
I mean, going back a bit further than that, last calendar year was a big year for the two auction teams with over £1 billion sold. So looking forward to where we are halfway point this year.
Did we nudge 3,000 lots in that year?
It was more than that, yeah. So it was a big year in terms of, and obviously a challenging market for both sectors, residential and commercial. Fast forward to here and now in this calendar year, where 6 months in, near as damn it, as a business collectively, we've done over 1,000 lots that have been sold, raising in excess of 400 million between us. So that's not a showing off exercise. It's more that it's a very tough, challenging market for any agent out there and for everybody operating in the property business. But it is still moving, and there are still transactions going on, and it's really an insight into what's happening, where pricing really is, what's driving pricing and driving decision making from sellers and from buyers.
Richard, you've always said that the flash to bang in residential, so between a seller deciding to sell and sell, is actually quicker than commercial, because I guess because the vacant residential is more vacant property than the commercial, which is investment. Is that fair?
I never really thought of it that way, but it's a higher volume business by virtue of there are more residential properties in the land, as simple as that. And we operate very well in any part of the cycle, has to be said. When the market's flying, there's a lot of trading going on, a lot of property companies selling, a lot of moving parts, and a lot of people out there selling. When the market gets tighter, we're reliant on those, as you are, that need to sell rather than waiting out the market. And that's kind of where we are, I think, in the market at the moment, isn't it? That if there is a need to sell, you're going to sell. If you don't have to sell, whatever reason that might be, you might hang on. And that's kind of where we feel we are. It's no different in Resi. It just feels like, and it seems quite clear to me, that there are far more sellers with far more property that are in a position right here, right now, and have been for a year and a half, where they need to sell, whether that's raising capital to buy other stuff, whether that's raising capital to rebalance the books and interest rates going up, all manner of reasons. But you look at the housing associations, we're selling an awful lot for. We've done a big breakup of REITs that have had problems within them. There's probally more distress in our market in terms of buy-to-let.
Before, in the commercial market, we'd say is impacted by the government policy, but actually housing associations are needing to raise money because they're not getting any anymore, which is driving volume.
Yeah, it's probably dangerous for me to speak on their behalf, but from what I can tell and what I can see is that housing associations, councils, some of those sorts of sellers are under similar pressures to the private property companies in that they have debt. So interest rates going up on their loans coming up means it has impact on their balance sheet, on their books and their cash flow.
Refurbishment, replacement.
Precisely that, the cost of build. So typically, 15, 20 years ago, a flat that a housing association had, when a tenant moved out and been there 5-6 years, it was tired and run down, they'd spend the money, the capex, doing it up and letting it again. Now that's become hugely more expensive just to refurbish a flat. So that's driving to so actually we better sell this because they're in prime locations a lot of the time, and we can reinvest that money in new build. Now that's been going on for a long period of time. New builds had issues of cladding and all that kind of stuff. So they've got lots of things to spend money on. So they've got reasons to sell. And selling through auction is a very good way of them selling on a regular basis to get their cash flows in. And actually, to be blunt with you, a lot of the properties they're selling are best sold at auction anyway.
Yeah, and they're granular, so the unit cost of doing that flat up is best left to the private sector.
Precisely, yeah.
Yeah.
I think all of that is probably linked to what we always crave is motivated sellers.
Yeah.
And the motivations are so different. Not rushed sellers, that's a whole different story, because sometimes rushing doesn't help you out in the long term. But actually motivated sellers with a reason to do it and a strategy that is, it's not an immediate snap decision. It's been planned out and they're motivated and they know their cycle throughout the year.
So in terms of the sellers in the commercial world, I guess they're, how do they divide up? I mean, are there many funds? Is it private traders? What's the sort of balance?
We'd always say it's the usual mix. I think the private trader will be the bulk of the catalogue, the private investor, private trader, whatever you want to call them, will be the bulk of the catalogue running through. Yeah. And then we do sell for funds, institutions, and receivers here and there, administrators. They're never going to be in the volumes they once were and form a huge chunk of the catalogue. So it is still the private market, private propcos, et cetera, that are selling for many of the same reasons that Rich just said. And
so when you've got a sort of a seller driven by valuation metrics, I mean, is the market and that valuation close enough at the moment to generate trade?
I think if we look back to what we talked about last year, we felt the market had caught up with the valuations or vice versa. And so some of the valuation pegged sellers could start disposing of their assets. The more formal, the regulated funds, etc. For the privates, it's more of a personal emotional valuation as opposed to something written down in paper with regulations behind it or rules that they need to follow. There will always be a disparity between valuations and what you achieve on the day where your reserve needs to be set. And I think there was a period where they were getting very close and more aligned. Then they drifted away a bit, but I think the aspirations on both sides of the transaction are getting closer again.
It's interesting because if you look at the overall stats that EIG produced, they would say success rates have improved. And I wonder whether that is because the sellers in both markets, but it's more notable in commercial sector, the success rates are improving and we're knocking north of 80%. Is that because the aspirations of sellers are meeting the market more? I mean, is that coming back again?
I think it's buyers stepping forward a little bit and seeing some value. I think it's something that we've craved for a long time. There's so much money there. It's waiting. It's cautious. But actually, people have always seen value in certain things. And I think we'll go on to talk about what have been the most sought after lots. But actually, if people can slightly broaden their horizons and see value on a wider perspective, that's when they step up, edge their pricing up a little bit. And also sellers listening to feedback, being realistic with pricing. It's the same old auction story.
It's the pricing chat, isn't it? We've done it before.
But you mentioned, and I see that as well, but you say there's buyers that are waiting. This might be a daft question, but what are they waiting for? Is it simply a change in interest rates or is it something else they're waiting for to take the plunge?
I think if it's a private investor, they're waiting for, or they've probably been slightly hesitant because of all the geopolitics that's been impacting everywhere.
And there's been a lot of that.
In the last 12 months, 18 months. Change of governments here, change of governments in the States, everything else. The threat of tariffs. We don't need to list all these things, the wars that are going on, the conflicts. Stability, our buyers are mostly medium to long term. So they don't want to suddenly make a snap decision today that they might think might not benefit them further down the line.
That's interesting because I think that's one of the, in some respects, there's a more varied motive for buying in resi compared to that. In that
emotional.
But I think what I mean by that is that you'll get some that will be, as you say, medium to long term investors, but some that are very short term investors that are buying at auction, which you don't necessarily have as much as that. So if you're a medium to long term investor, surely you smooth out a 5-10 year period, now should be a really good time to buy, right? If people are hesitant and you've got a market that's a thinner pool of buyers, you would think...
Yeah, I mean, I was going to say, do we see, I mean, with the high street, it's sort of averaging 9-10% of your bog standard lot. I mean, are we seeing bargain hunters? There's a capital there to do it? Is the intention there to do it? Yeah.
How do you define a bargain hunter? Yeah. There are always those that are off the pace and sort of leaving a bit on the table sort of thing. But I think we will see... I think we're hopeful that we'll see at the back end of this year, there'll be a bit of, right, come on, let's get on with it.
Yeah.
Um,
I was interested to see
because
what Alex Butler's his team, they're seeing a lot of French capital. 12 months ago, we hadn't heard French capital. French capital investing in UK assets, and I don't mean London, I mean across the UK. I mean, we've seen a smattering more in our smaller market of foreign capital.
in the last auction, we had buyers that were based out of Spain, Canada, South Africa. It's still hugely domestic market. There is Middle Eastern money that comes into our market, and speaking to various clients throughout last week, they've got mandates for new Middle Eastern clients looking to buy into UK real estate, and that's a bit of a boom both for the sector itself, but also our reach that we can get out and find these people.
Yeah.
Do you find because I've noticed over the past probably 18 months that you get from one auction to another, and for us in the resi side, we're sort of 11, 12 auctions, pretty much exactly one a month, that you will see differences for very similar stock month to month for no real apparent reason.
On a pricing basis.
Yeah. I mean, not huge amounts, but I'm talking about, something that might sell for 250 in May will sell for 280 in June, and then you go to July and it's back to 240. And there's no particular. It's a bad example, but it's giving you a gist of actually just little nuances from something that's very similar.
We're at the front of the market, so what you're saying is the market does work. I mean, that's the.
It does, but it just there are little peaks and troughs month to month, which in some part might be due to the fact the market is reasonably thin in certain areas. So actually, you're looking at 2 or 3 buyers. If one buyer's not in the market that month, it changes the pricing on it all. Yeah. But we often not measure, but we know the market feels stronger when the buyers are more often than not traders. If traders aren't buying, the prices are quite strong. And the traders will say that themselves to us. They'll phone us up after and say, I didn't buy
sheep mentality.
I didn't buy anything, which means you've done well. And that's a good way of telling really where the market is. But I noticed that from month to month changing. They'll buy loads of stuff one month and nothing the next month.
Because they think it's too strong.
What's interesting for us in the resi side of things, a lot of those guys will deal with buying stuff at auction, adding some value in a short space of time and then selling on the open market. And I noticed at the beginning of the year, January, February, March, they felt they were struggling on the open market with some of the stuff they'd bought at the back end of last year. So they put the brakes on purchasing because their exit wasn't as quick and as fluid and as good as they thought. When that picks up, they start buying again. So it is linked to that market.
Stamp duty backlog when the lawyers just couldn't have the work, as far as I understood it. So you had these rising demand, but you couldn't. The market couldn't process that. Had those private treaty lawyers had auction contracts, have been different.
Yeah,
but we've banged that drum a few times. But it's always the same, isn't it? So, what do you think, Will, in terms of commercial, would really put a bomb under activity and just get people back in it? Is there anything you think? I mean, interest rates are trending down.
We could talk about that till the cows come home. 1/4 point in May, nothing in June. There's a perception that will ease, but when is that going to happen? How quickly will that motivate sellers to hold on because yields should follow suit? Well, how long do you wait? It works on both sides. So I think it's just that period of stability. I think the latter part of this year, it just takes, like you said, the sheep mentality. And that's not said in a derogatory way. I think once people see that people are transacting on certain things,
it gives them confidence.
It gives a little bit of confidence to see that you might not be or feel you're the only person out there.
Yeah.
And actually now is the time because there is value.
Yeah.
And it's seeing that value and putting the other hat on and not seeing the caution or the potential downside, looking longer term and medium again and seeing that potential upside again, thinking, let's get on with it.
Yeah, I mean, so I've looked at a couple of commercial examples, and I won't drone on about them too much because, of course, you can't see an example on a podcast. But one of the challenges we have with pricing, which we talked about earlier, is that good old high street. And I was talking to a mate at CBRE yesterday, and every decent shopping centre or pitch is full on the high street or shopping centre, and they've got lines of people wanting these good established positions. And obviously, it doesn't cover all the stock in the auctions, but it's an indicator on the retail market. And some of our clients will tell you that the local parades, the £30,000-40,000 a year, all those rents are solid and improving. So one example was a little bank in Aldershot, and those of you who have bought certain leasebacks from the noughties, from Barclays and Lloyds and everything else, will relate to this. We had a little bank in Aldershot, which there's a year left on the lease at 35 grand, and we put that in at just over 400,000, thinking, well, the Aldershot is not the greatest town, the high street's suffering. Are they going to take a new lease? So we put it in a book of 400,000, and we got over 700. £100,000, so just below 5%. For
Why did someone bid to those levels?
Why did someone bid to those levels? Why did two people bid to those levels? So you would never put a short let bank at 4.7% worth £139 a foot.
You wouldn't put a long let bank.
No, but is that driven? That must be driven from alternative uses, right?
I think, Richard, but yes. I mean, two people at least thought so, and I get it. But it shows the example. We've done. There are 2,000 high streets in the country when I started. There's probably 1,000 viable ones now that we know. But even in the south, we're saying that some of these difficult spots in high street, the rents are very hard to understand. The market proved us wrong. We had on that 15 bidders, and it's really nice as an auctioneer. It's great to be proved wrong.
Yeah, absolutely.
But those are the hard ones to price, though. Short income buyers will have a huge spread on what they think their ERV is in the future, whether the bank's going to stay, whether they're not, what the likelihood of getting consent upstairs, what the cost of conversions are.
Yeah,
everyone's inputs are so varied.
They are, aren't
they? That's where the auction is a great platform to bring out that inherent value.
Yeah, and then as you said earlier, you get 1 month you get a peak, next one you might get might not. So it's interesting. And then we've got other examples where the smaller, SIP-friendly little £200,000 funeral parlour on a long lease in Cirencester, lovely town, and that again it's 170% of the reserve price.
Gloucestershire bias coming through there.
Just 5%. Oh yeah, Gloucestershire bias, but it's a little town. It's a little odd. It's just under 200 grand. And the other example, obviously, and Richard, you're seeing this. I think you sold was a lot over £4 million, the London lot recently.
We did, and the three of us were talking about this before we arrived here today at breakfast. And it sounds so simple, and it's easy to say because it's not our money. And I say that so many times to people that in a market particularly challenging like this one is, where you've got thinner buyer pools than you did 2-3 years ago, the pricing is key. And that's a good example. That was it's a big building being sold, 18, 20 flats or so. The point being there is that it had to be sold. They're very familiar with the auction process. They're very familiar with our standing in the market and how deep our buyer pools are relative.
Yep. And they're familiar with trusting the process as well.
Trusting the process. So it went in at what it was probably on the book, and it went in at something like, I don't know, 800 grand, and it sold for over 4. Now, had that gone in, it sold for 4.3. Had that gone in at 3.5, we might not have sold it. Is the point I'm making. And it's very, very easy for us to say that. It's not our property, not our money. But those that commit to the process, are aggressive with the pricing in a market that is tight, will get the best outcomes. And we proved that time and time again. And we had something we had a student. It was a complicated lot. It was leasehold. It was sat on a car park, but it was central Birmingham. It was a student building. And it was fraught with all sorts of problems and challenges and costs coming their way. Fire regulations, cladding, all that kind of stuff, which was very open for people there. And there were very, very big student operators selling it. Just wanted rid. They put it in at 200,000, and we sold it for 1.3. Okay. Again, because they had the confidence in trusting that. I know it really. I keep saying it easy to say they had real confidence.
You're saying the seller has the confidence. So we need to sell this. There's lots of reasons. We're being honest about it.
Yeah.
We describe it accurately with all warts, tenure, title.
Everything
issues.
was there to be shown. Yeah.
And we are sellers at that guide price.
And we are selling. Yeah. And Birmingham, fill your boots. And they did. It's interesting, isn't it?
Yeah. Like I say, they were a very non-emotional seller. They've got a huge, huge portfolio of very good, high quality student accommodation all over the country. And this was a liability on the balance sheet for them. It was more trouble than it was worth. It was a risk to the brand, all that kind of stuff. So they had a real commitment to sell it, but they trusted in that. And they trusted in the fact that we knew what we were doing, because it was so hard to value. It was very much like you're saying there, because of the issues it had. If you've got 100 valuers to value it, you'd have got 100 different numbers all over the place, because it was just impossible. So let the market lead you. We know you've got the buyers there to do it. Let's go with it. And they were delighted with that. Now, we get a lot of that with the housing associations and the councils, some more so than others, but it is that commitment to price. And you prove it, don't you? Once you've proved it once with a seller and they understand the process, understand that the pricing works if you listen to the advice, then they can follow. So it's
and
that first
are
one.
These buyers buying off current yield, future hypothetical yield, or are they buying off unit pricing?
I mean, that's for resi. It's not not simple as that. It's probably more simple. It's all to do with capital values of properties. What the real shift, and I'm going to say, obviously, cheap money for the past 10, 15 years has made it easy for a lot of people to buy, and with great capital growth, they accept very poor quality yields. So if you're borrowing at 2-3%, you take a mean yield. If you're getting 10% growth year on year or 5% growth year on year over 5 years, happy days. That growth slowed down. Yes, rents went up. Cost of borrowing went up. So actually people in the resi sector were looking very closely at yield because they weren't getting capital growth in a short, medium term. they needed to make sure it was washing its face at the very least. And that's really shifted the yields, really shifted in the past 3 years.
But that shifted the rate per foot of particularly London assets in your world, because you've got to have a low rate per foot to give you the yield.
Yeah.
So it's slightly more akin to the pricing in our market. And, if you assume that we're selling 5-year leases, that's quite relatively easy commodity. If it's 10%, it's really high risk.
But as Richard said earlier, you would think if you had 5 identical shops let to similar covenants, that the yield spread should be very narrow. They should arguably all be worth the same. But actually, what the market's proving is there isn't any consistency.
No. And back in the day, to sound like an old man here, but 10 years ago, we would produce data with A grade, B grade, C grade retail, and you get a pretty tight graph, and it would be consistent over the year, gently improved, and or not. And that is, we don't do it anymore, not because we haven't got the data. We got buckets of data. The consistency isn't there. And it's not a north-south divide. It's not anything else. It's just there's no consistency. What makes it hard.
But for your market, 90% of what you sell is income-producing investments, right?
Yeah.
Or more so. So would I be right in saying that actually there's 2 key drivers for you, the cost of debt are the key drivers for people making decisions to sell or to buy?
Because that's comparative return.
Yeah. And again, stating the obvious, it's the covenant. So whether you're getting a shift in the high street and, a change in the high street and people being more online, they're the 2 main drivers as to the strength of a covenant in its true form right here, right now, and the cost of borrowing are going to be the biggest impacts on the market going forward.
I think there's a twist to that, Richard, because a lot of our investors would rather have it's a little bit about the rent.
Affordability of rent.
If the rent's affordable, they're quite happy to have a coffee shop in at 20 grand a year, rather than a corporate. So, for example, we sold 220 Boots, and they're quite hard. They're like the Philip Green of old. A hard tenant to deal with. And some people would rather have a private who's paying the full rent. Now, if the rent looks really quite high, of course, you want the covenants, you want the repairing, you want the rent certainty that a corporate will give you. And bear in mind, we're not dealing in central Cambridge in terms of our lot size. We're in market towns in peripheral London, so we're dealing with more privates. So there is that balance. But if you have, IBM on a lease for 10 years, it's about covenant length of lease.
It's interesting. It's slightly, trying to relate that to resi, you will get some private landlords that say, actually, I've had a tenant in here for 5 years. I've barely put the rent up because they've been good as gold.
Yeah.
And they, something goes wrong with the boiler, they get someone to fix it, they don't bother me, they're fine. And then you'll get someone with the flat above who's got them rack rented up into a market rent, but they might get more voids, they might get a more difficult tenant, and that's actually not what they want. So they're prepared to pay more for the security and less of a headache.
There's so many things in that phrase "good as gold," because it means less hassle and less wastage. The gross to net in resi. If you're not constantly putting money out to do this and do that,
and time,
and the hard message on both sides is to pass on that message to the market, because they might not have great financials that you can put in the catalogue and people understand who they are. It's hard to say the landlord hasn't had any trouble with these tenants. They paid on time, every time, rent, service charge, everything.
In our world, it's a spreadsheet, isn't it? Do they pay or do they not? Okay. So any particular, just a little bit of a review of the sectors, because commercial covers retail, industrial, alternatives, offices. Where are we up to retail? I mentioned earlier, Will, that it seemed to be solid. There are plenty of towns with lots of empty shops, but where do we feel generally rents are to give those investors a view?
I think most people are of the perception that the rent and rebasing post-COVID is done. Clearly, there are some legacy 20-year leases of old where there will be a rebalancing, but I think the perception is rents have been revised, rebased, whatever you want to call it. I think still 70% of what we sold this year has been retail, back up to where it used to be in terms of a percentage.
Investors understand it.
Yeah. And there is rental growth in certain places. The neighbourhood parades will always be popular.
I must have mentioned the Bishop's Stortford one yesterday. I saw the rent was 50. It's gone to 87,000 with a competing tenant at 90. This is a high street shop. Sounds like a lot, but it's a southeast town and it's a good town. So there's examples. And those swallows, they're not just swallows making a summer. There's evidence there. You talk to Tony Clarchie, they'll say
exactly. And rarely are we dealing with a shop with £200,000, £250,000 rent. It's not our market. Yeah. So actually the market we're operating in, usually not much more than 100,000 and often as low as 15, 20, is there's comfort for most people. And again, it comes down to location. It is old-fashioned fundamentals. If people have got the cautious hat on, it's old-fashioned fundamentals, location. That's my bedrock of fallback. Yeah. I can always relet this. So It's that replaceability. When you haven't got the covenant in there or you've got short income, can I replace these tenants easily? Well, it looks affordable. It's well located. Actually, this high street's doing pretty well.
Yeah.
And
So
yes,
it's a big uptick there.
of course, if you're secondary, off-pitch, tertiary, towns that are really struggling, then it's probably not the sector to be buying in unless that yield is so attractive that you can't not.
Yeah, and you've got some examples. That bank in Bradford at the moment is a 16% passing rent in a big centre like Bradford, but the rent is probably 40% too high. So in 12 or 18 months, that's going to come back down to 10%.
But they've been there for donkey's years. It was a sale and lease back in 2006. Yes, someone paid £3.2 million for it back then.
Do you see, as a consequence of what's been happening with the high street, and obviously your 90% or a high percentage of your volume is retail, do you see a lot more vacant units now? A, on the high street and where you're selling, but B, in the catalogues of what you're selling?
We did an exercise recently. I think we've sold 50 million vacant in the last 12 months, which is a lot more than normal. And so, yes, Richard.
Which stands to reason, isn't it?
It does stand to reason. And there is quite a decent market for it, but the levels of realisation are very low. And it comes back, it can be down to £5 a foot. You've got 85,000 feet in Carlisle.
And Doug's in Crewe in the July auction.
Yeah.
I think it's the old M&S.
An ex-M&S in Crewe, and it's got
£5 a foot capital value.
Capital value. And the rateable value is
Big island site.
So. And who buys that kind of stuff? Are those people that are going to repurpose it or go through planning, or are these people that have got ideas about retail going back there?
The added value buy, Richard.
Yeah.
But, I mean, people with different ideas, isn't it?
Yeah.
So you might put leisure use upstairs. Indoor go-karting, soft use. I mean, it's strange things that are really happening in the indoor golf concept. This sort of urban leisure thing, if you can buy £5 a foot, their operators will pay £1 a foot, suddenly 20% return.
Yeah,
it's a different dynamic, and I think each property is different. We are selling more, and provided it comes back to this, can the seller sell?
And also, occasionally owner occupiers, but generally not owner occupiers that are buying these things.
Yeah, they've largely gone, haven't they? I mean, B&M used to buy quite a lot of their stock.
But in terms of the vacant stock,
oh yeah.
Occasionally you would find the owner occupier that wants to come in and start their whatever sort of business out of it. It's not so much those people that we're talking to.
Yeah.
With in terms of buyers, you do go through a process of analysing your buyers far more than we do, but do you find the bigger the lot size and or the further out you go into the regions, the more local the buyers are to the property?
Depends on the property.
We always say that, don't we?
But, I think if it's vacant, it's more likely to be local.
Mm-hmm.
But what we've found over time is that as people perceive there are fewer opportunities, there's less stock around, they've had to travel further to go and find the deal. They're less geographically tied than they've ever been.
It's deal driven, yeah.
Of course, you're not going to, if you're not going to be buying in the tip of Scotland or the far end of Cornwall, if you still need to be slightly hands-on. And if it was on your patch, you wouldn't have to pay managers off-site that's eating into your returns, etc. But actually, if you've got money to park, you want to buy the best deal. It doesn't matter where it is.
So buying at the moment, let's say for the last 6 months, this calendar year, has your buyer, the actual buyer, not just bidders, but the buyer profiles changed at all? Are they new to the market? Are they people you know? Is the mix changed from a year ago, 2 years ago?
20-30% new is constant. It doesn't go away.
Really?
People just fancy a go at something, yeah. Because
and are they new to auction or new to commercial property?
Commercial property.
There's a fair few that are sort of dipping their toe into the commercial property world, probably having moved away from your side of where things are. Because of the tax implications and sort of dwindling returns as they perceive it. And some of them are educated and some of them need a bit of assistance on the way through.
Yeah.
And it's
and
very much...
Will and I talked about this yesterday, sort of the up to 500,000 is kind of the domain of the new person. Between 500,000 and 1 million, you need to be quite a bit more sophisticated. Above 1 million, the buyer is typically someone who's got a portfolio, who understands and takes views and things. But there's a possible little void. It used to be above 3 million, that void. One has come down a bit now.
I'd say our familiarity with the buyers increases as you go up the lot size curve.
Yeah.
We've known them, they've got more.
And with those that own portfolios, have you seen in the past 2.5, 3 years with interest rates moving quite a lot compared to the old days of cheap money, those that own portfolios selling a few to rebalance a little bit and put more equity in when they come out for refi? Have you seen some of that, or is that?
Yeah, and I think that my experience of that is if it's a refi of a dozen lots, the banks are not fighting. They're saying, well, clearly the LTV has been breached. How are we going to deal with this? You could sell the best one, you could sell the poorest one or two. Just, you've got 12 months to sort it out. And I think that in contrast to, well, when you started, you know, the banks screaming and it was a bit different. And also some of those owners are, I'd say, quite bold in taking on bridging finance, which isn't actually that expensive. If you believe massively in getting a vacant building let, can be worth bridging. But yes, they are in a situation where there's a 12, 15 lot portfolio and on refi, they would sell some typically.
Because we do see some of that, and we have done for a long time. And it's actually, you always see that when there's refis coming up, it's more expensive. One of the options is to sell some of the assets to change that equity position. But what we're seeing, and it's talked about quite a lot, and we still don't know which direction we're going. Well, we know the direction of travel. We don't know what it's going to look like. Is the rental reform in residential, and how private residential landlords have been treated over the past 10 years. And how less appealing it might be for new entrants. So we have seen, whilst there's still plenty of activity out there, we are seeing some and advising some landlords that are saying, I'm a bit tired of this now. It's just too penal. It's too complicated. EPC rating changes coming. There's potential rental reform where you might be pinning rents down or having to be reviewed in a different way. I'm not interested anymore. And more often than not, they're of an age, let's say, where actually they might have been part of their pension. Thought, actually, I don't want to be a landlord anymore. And we have seen some of that. So we've got different additional motives to be selling at a time.
But, let's take the flip side of that. So people exiting the market, so rental growth is going to keep creeping up.
Yeah.
I got one client with a portfolio of a dozen southeasty lots, all outside London. Rental growth in the last 12 months, 15% on the resi portfolio. Now, clearly there's been an urge, a shove to get them up ahead of the rent reform bill, which is possibly coming in the autumn. But I think the response, the opportunistic landlord might think, well, okay, there's plenty of people leaving the sector. Let's get buildings which are up to spec. Let's understand, let's pick the right tenant, as you said, the good as gold one, if you can find such a thing. And perhaps you will see a continued rental growth.
Yeah,
that's what they want, is return.
I think that's some of the sentiment from some of the people that are selling. It's a personal choice. I'm not interested in that sector anymore, or I want to get out of that sector. You're right, without question. With that comes a lot of opportunity for new entrants or existing landlords in the market. I know I've said this a few times on our podcast over the years, but where we are gravely different to the commercial sector is that people live in residential. Now, whether they're renting or owner-occupying, we have a huge housing shortage. More people coming into the country, not enough houses being built. That will always underpin the demand in the market. Now, that's shifted from more people having to rent, and that might, when interest rates come down, more people being able to afford to buy. But it's still the same levels of stock that are just swapping landlord profiles, if you like.
It's not changing by 500,000.
No, so exactly. So it will come with opportunity. We see that people are seeing an opportunity who've got probably more hunger and appetite to get their teeth into that sector.
Yeah, and it's one of the things we picked up on is actually sort of the boomer investors who are now, dare I say, it, something like 60 and find themselves with a family prop or portfolio. When actually the next generation don't want to take it out.
Not interested.
And they think it's a mysterious world where they can invest on their phone. So a lot of people are getting to a point where changes in IHT, well, just cash in. And I think there's a measurable amount of that in our market, which has it always been there? I don't know. Perhaps it's because I'm possibly at a similar stage, but that is another driving force because people don't necessarily think it looks complicated.
But the beauty of that and property is that opinions always vary.
Yeah.
So one man's, I want to get out. It's the sector's not for me anymore. It's another man's, I see opportunity here. And if we're lucky in that sense that different opinions and different reasons to be in the market. If you're in for a short term for a trade, if you're in for 5, 10 years, 20 years, why wouldn't you buy residential? There's not been a period over 50 years, a 10-year cycle whereby cap values haven't gone up in resi. Yeah. So if you're in the long term, you just ride it out.
It's no different to tweaking your pension investments as you get to closer to retirement age. Is it? De-risk it a little bit. It's absolutely no different.
A little bit of a dig.
What about Rich? You talked about reform coming. Ground rents. I know you're not a ground rent specialist. How's your market viewing residential ground rents in light of what's happened?
It's a really good question, and one I can't really give you a particularly good answer to necessarily. But we are still selling them, and they have changed an awful lot over.
They're the long and boring investments, aren't they?
They are, but and they shifted in terms of how we, when I first started, these things were selling 20 odd years ago for 20, 30 YP, sometimes better depending on what they were and where they were. when we now price them for the purposes of reserve at probably no more than 10 YP, and they might go 10 to 20, 10 to 15, something like that. So they've come down sharply, but there is still a market for them. And there was a period of time, a short period of time, people weren't doing anything. I don't know the direction of travel here. I'm not sure I want to get involved. So there is still a market for it. It's just not as pricey as it once was.
Yeah. I'm just conscious of time. Will, we've talked about retail. I think, let's just cover off industrial. One point it was trading at 6% or better. That seems to have backed off a bit with rents up in double digits. Some of these local...
Lot size, hugely dependent.
Yeah.
The little multi-let parades, industrial estates will always be hugely popular.
They are popular,
roll your sleeves up,
people
bit of management, that sort of thing. I think but people don't understand the tenants as well as they do retail. It's a simple fact.
Yeah.
The concept of everyone having seen the industrial sector have its long-term, a decade in the sun, if not longer, is people do want to get into it. People have got into it, but we've never really seen a huge amount of it.
I mean, the English estates back in the late 90s, but since then
we've sold it well. We sold it for the your client
Warehouse
probably
Reed.
18 months ago, 25 million in an auction for them, all big ticket stuff.
Yeah.
But I think it's, again, lease length, understanding the rents, understanding exactly what they do from those buildings.
I also think there's quite a demand outside the auction room for that. So
huge amount.
It's a big country auction for that. Alternatives is always something that, and we seem to have a run in funeral partners and vets recently.
So we've done sale and leasebacks for funeral partners for a long, long time.
Yeah.
Gregor
and the vet
deals
world
with
is
them.
coming to life. People love a vet.
Vets, doctors, dentists, funeral partners.
And these best prices on vets are, again...
Long income, often index linked, often with underlying residential value.
And it's a fit out, not like a pub, but a £2 million, £3 million vet surgery takes a lot of fit out. So they want these long leases.
And often these are small local practices, maybe one or two outlets that are being subsumed by bigger entities. Comes with a freehold, sale and leasebacks.
Yeah.
So they've always been popular.
Good long leases with
increase. And the lot size on those is very varied as well. So it's actually, there's a full spectrum of buyers that can come in. Because some of them will be down in the £150,000.
As we saw with the
and
funerals.
up to plus 1 million. So real spread on that. And what else could you throw in there? Roadside will always be popular as well.
Yeah. Roadside in any form.
Yeah,
people
tyres.
keep moving despite the internet and high street. Yeah. Okay. Good. Richard, so final thoughts. I mean, we said your sellers tend to be able to price where the market will be attractive. Pricing is king, isn't it? And trusting the process. I think, interesting, Will and I have discussed this. Next 6 months, trust the process, it'll look after you.
Yeah, well, I think we've got an interesting 6 months ahead of us. I'd like to think the market's going to only improve, and it's driven by, I think you started on this point, is that in many ways the residential auction market isn't and shouldn't be that sophisticated. However, it is still heavily influenced by general consumer confidence.
Yeah.
And when you flick the news on and see all the nonsense that's going on in the world at the moment, it does affect people's general confidence, and that affects their behaviours and buying behaviours. Not everybody, but a lot of people. In theory, if you park all of that for the time being, it really should be driven by supply and demand and the cost of borrowing. And if we see another interest rate or two, August and towards the end of this year, and that becomes broadly the new norm, I'd like to think people would say, right, now's the time to go. This is the new norm. It's been a bit of a rebasing, as you put it, and let's move on.
Because supply will always be the issue on your side.
Correct.
And Will, with average private treaty transaction taking 6 months, I mean, people are turning to auction, but, wouldn't it be lovely if everyone just cracked on?
Yeah, and comes back to trust the process, trust the marketing, but also it is a sophisticated market. They are sophisticated buyers. Part of the reason that everything is slower and they're thinner because everyone's being so forensic.
Because they just have the time.
Because they have the ability to be forensic, and people are less willing to take a view on something. They need to tick 90% of the boxes now. If the market starts moving, they'll be comfortable ticking 70% of the boxes before they decide to dive in.
And in our world, we do try very hard to get under the skin of these particularly bigger assets and work out any issues there are so we can present the truth to give people full knowledge up front rather than stop ticking boxes later.
It's interesting.
No, but in terms of from their mindset of actually choosing to buy.
Yeah. Okay.
It's interesting in that, and our private treaty partners will not thank us for saying things like this. If they don't like it, I'll blame one of you. But I think, we've been in and are kind of coming out of a market whereby I think people that are buying private treaty, even in residential, but also particularly in commercial, whereby if you're given too long, you'll find something you don't like, talk yourself out of a deal, because that's your mindset. But also, if you're bidding and you have an offer accepted, instinctively in this sort of market, you think, am I overpaying? Whereas in a bull market, when it's flying, you want to get it completed quickly before you get gazumped, and the market keeps going. And that's that's a matter of fact. And the auction takes you out of that. It's you have the comfort as a buyer that you're only one increment above the person beneath you, so you've got the kind of volume there. And actually, also, there is no going back because it's done and it's exchanged. So it does work really well, in my view, in all markets, but this market in particular, for the seller, but also for the buyer. It gives you confidence.
Buying competition. Be happier, sleep better the next day. Good. Okay. Well, thank you very much, folks, for that contribution. It's been a while. We'll discuss some of the more popular lots of the last 6 months in a blog that's coming out soon. But Will and Richard, thank you very much for your time.
Pleasure.
Thanks, George.